All right. Welcome, everyone, to another deep dive.
Yeah, excited for this one.
This time, we're tackling something pretty big.
Pretty big, yeah.
The Federal Reserve System.
The Fed.
We're basing this deep dive on Murray Rothbard's The Case Against the Fed.
Mm-hmm.
Like, you guys are here listening because you want to, really understand these complex topics.
Right.
But without kind of getting lost in the weeds, right?
Yeah, absolutely.
We want to give you those core insights, maybe some surprises along the way.
That's what we aim for.
And today's no different.
No, it's not. And Rothbard, he's such a clear thinker.
Yeah, and he's provocative, too.
Yeah, he doesn't pull any punches.
Not at all.
So our mission today is to really unpack his critique of the Fed.
Okay.
We're going to go through his perspective on everything.
Everything.
Like from the very nature of money itself.
Okay.
All the way to, the historical events that actually led to the creation of this really powerful institution.
Yeah, I mean, it's a big one.
Huge.
Like, what is money? How did it even come about?
Right.
Why gold?
Exactly.
What are the problems that central banking, in theory, is supposed to solve?
Mm.
And did it actually solve them?
Yeah.
Did it create new problems?
Yeah, I think the listeners are going to be quite surprised by some of this.
I think so.
Rothbard really digs deep into the history.
Yeah, he does.
And, his work goes through free market money.
Right.
The dangers of central banking, especially fractional reserve banking, and the specific history of how the Fed came to be. So we're going to extract those essential arguments so you can grasp his central thesis.
Right, let's start at the very beginning with money itself.
Okay.
So Rothbard, he makes the case that money, it's not something that governments just invented,
Yeah.
It comes about naturally.
It emerges,
In the marketplace as people are looking for better ways to trade.
More efficient ways, right?
Than just straight bartering, right?
Yeah, bartering gets complicated quickly.
Oh, yeah, absolutely. It's like, I have chickens.
Right.
And you have wheat, but you don't want my chicken.
Right, exactly.
So what do we do?
Well, and that's where Rothbard's explanation of this organic development is so fascinating.
Yeah.
He points out that when this direct exchange, like you were saying, becomes a hassle, people start looking for a middleman.
A middleman.
Or a middle good, I should say.
Oh, a middle good. Okay.
So, let's say I have chickens and you want them, but you don't have wheat.
Right.
But you have, I don't know, leather that someone else wants.
Okay.
Maybe I can trade my chickens for your leather, even though I don't need leather.
Right.
Because I know I can then trade the leather for something I do need.
Oh, okay. So it's indirect.
Exactly. It's indirect exchange.
Okay.
And over time, he says, what happens is a particular commodity becomes really widely accepted in these kinds of transactions. And it kind of just emerges as, the go-to.
The go-good.
The medium of exchange, right?
Yep.
And that's the essence of money.
So it's like the most useful one wins.
In a way, yeah. Like a natural selection for trading tools.
Oh, interesting.
The more it's used, the more people trust it, the more accepted it becomes.
Huh.
And Rothbard, he stresses how important money is for something we just take for granted.
What's that?
Economic calculation.
Oh, yeah. Okay.
Like without a common way to measure value, how can businesses figure out if they're actually making a profit?
Right.
Imagine trying to compare apples and oranges, literally.
Yeah.
But even more complex things.
Right, like a haircut and a car.
Exactly.
Yeah.
You need that common denominator.
Right.
And money, it provides that.
That shared language.
Exactly. The language of value.
I like that.
And this is where gold and silver come in.
Okay, so historically, gold and silver, those are the things that become money, right?
Right. And Rothbard argues it wasn't random.
No.
These things have certain qualities, like built-in qualities. He calls it moneyishness.
Moneyishness.
Yeah. It's a funny term, but it makes sense.
Okay.
These things are well-suited to be money, like their supply is limited.
Okay.
They have value in and of themselves.
Right.
They're portable. You can divide them up.
Yeah.
They're homogeneous. Like 1 ounce of gold is basically the same as any other ounce of gold.
Right. So it's like they naturally kind of fit the bill
Exactly.
for being a good, widely accepted medium of exchange.
Mm-hmm.
It's interesting, too, even today,
Yeah.
our currencies, they still carry this history with them.
Oh, totally.
The British pound sterling.
Yeah.
It literally was a pound.
A pound of silver.
A pound of silver, yeah.
Isn't that cool?
It's wild.
It's like holding history in your hand.
Yeah, and the dollar, too, right?
Right. The dollar, it goes back to a silver coin.
A silver coin. So these concepts, they have weight.
Yeah, literally.
Literally, yeah. They have
Yeah.
history behind them.
And that brings us to a really interesting question that Rothbard tackles.
What's that?
The optimal quantity of money.
Optimal quantity. Like, what's the perfect amount of money to have?
Exactly. It seems like a strange question at first, right?
It does, yeah. Like, we don't usually ask about the optimal amount of, I don't know, food or clothing.
Right. Usually we think, like, more is better, right?
Yeah, more food, less hunger.
More clothes, less nakedness.
Right, yeah. But Rothbard says money's different.
Money's totally different. He makes this crucial distinction.
Okay.
See, increasing the amount of other goods, it makes society richer.
Okay.
Because you can use those goods, consume them.
Right. Wear the clothes, eat the food.
But money, you can't really eat it.
No.
You can't wear it. Its main job is to facilitate trade,
Yep.
to measure value, like we were saying. So printing more money, it doesn't magically create more wealth.
Right. It doesn't make more stuff appear.
Exactly. All it does is dilute the purchasing power of each unit of money that's already out there.
Okay. So if there are like more dollars chasing the same amount of goods and services, each dollar is going to be worth less.
Worth less. It buys less stuff.
And that's inflation, right?
That's the heart of it. Yeah.
Right.
And so Rothbard's big point here is, once a commodity is widely accepted as money, like gold was, any increase in its supply after that, it doesn't really help society.
Huh.
In fact, it kind of hurts.
Okay.
So whatever quantity the market naturally settles on, that's basically the optimal amount.
Interesting. So it's not about some government or central bank deciding.
Not at all.
It's like a natural process.
Exactly.
Okay. And that leads us to monetary inflation.
Right, which Rothbard defines very simply an increase in the money supply. That's it.
Okay.
But he uses a really powerful analogy.
Oh.
He compares it to counterfeiting.
Counterfeiting money.
Yeah, think about it.
Okay.
When someone counterfeits money, they're increasing the total amount of money out there, right?
All right.
And they get to spend that new fake money first.
Okay.
So what happens? They get richer, at least for a little while.
Okay.
But everyone else, their money is now worth less.
Because there's more money chasing the same amount of stuff.
Exactly.
Right.
So prices go up. That's what we call inflation.
Right.
And the counterfeiter, they benefit at everyone else's expense.
It's sneaky.
It is. And it's often hidden because there's a lag, like you said.
Yeah, between when the new money comes in and when we see prices rising.
Exactly.
So it's easy to blame, like, greedy businesses or whatever.
When the real culprit is the increase in the money supply.
Right.
And Rothbard, being an Austrian school economist, he goes even deeper.
Oh.
He says counterfeiting or inflation, it doesn't just cause prices to go up, it distorts the whole economy.
Okay.
It messes with how resources are allocated because prices are sending false signals and it violates property rights.
Okay. How so?
Well, imagine a free market where gold is money.
Okay.
There are only a few ways to get more gold, right?
Like mining it.
Mining it, yeah.
Selling something.
Selling goods or services.
Or getting it as a gift.
Right. Counterfeiting, it bypasses all that.
Right. You're getting purchasing power without actually creating any value.
Exactly. You're not contributing to the pool of real goods and services.
Right.
You're just taking a bigger slice of the pie without baking a bigger pie.
Okay, that's a good analogy.
And now, where does government fit into all this?
Yeah, that's the big question, right?
It is. Rothbard shows how governments can basically legalize counterfeiting.
Yeah.
Paper money.
Okay.
When the government issues paper money and says, this is legal tender, you have to accept it, they can just print as much as they want.
Right.
But Rothbard says there's an even sneakier form of this.
Oh.
Fractional reserve banking.
Fractional reserve banking. Okay. Now I got to make sure I get something. Yeah. Rothbard talks about loan banking.
Right.
And how that's different.
Yeah, good point. Loan banking is very simple.
Like, I have $100. I lend it to you.
Yeah.
The total amount of money hasn't changed.
Right.
It's just moved from me to you.
Exactly.
Wow.
Think of old-timey merchants
Right.
who also acted as bankers. They'd lend out their gold.
Okay.
But they only lent out what they actually had.
Got it.
Fractional reserve banking is different.
How so?
They lend out more than they have.
Wait, what?
Yeah, they issue more receipts for money than they actually hold in reserve.
So it's like, I have $100.
Yeah.
I lend out $100 to you. But I also lend out another $100 to someone else.
Yeah, it's kind of like that.
But I only have $100.
Exactly. They're issuing promises to pay.
Okay.
More promises than they could actually keep if everyone came asking for their money at the same time.
It's like those grain warehouse receipts.
Right. Rothbard makes that analogy.
Yeah.
Imagine a warehouse issues receipts for more grain than they actually have.
Okay.
That's fraud.
Right.
But that's basically what fractional reserve banks do with money.
So they're creating money that doesn't exist.
In a way, yeah. It's not real money backed by something tangible. Yeah, like gold. It's based on promises.
What if those promises can't be kept?
That's the big problem.
That's the risk.
Rothbard talks about two main problems for these kinds of banks.
Lay it on me.
One is criminal law.
Okay.
Like, initially, if you took a deposit that was legally seen as a bailment, like you're safeguarding someone's money.
Okay.
Not lending it out.
Right.
So if you lent it out without permission, that was like stealing.
Embezzlement.
Right.
Okay.
But then the law changed.
How so?
Court cases in Britain, like Carr v. Carr and Foley v. Hill,
Okay.
they reinterpreted deposits as loans to the bank.
So it's like, I'm giving you my money,
Uh-huh.
and you can do whatever you want with it.
Pretty much. Yeah.
And that's not theft.
Not legally, no.
Wow. But that doesn't solve the practical problem, right?
No, not at all. Rothbard says there's still a huge risk of insolvency.
Insolvency meaning?
Meaning they can't pay their debts.
Okay.
And he talks about two ways this can happen.
Okay.
One, the most dramatic one, is a bank run.
Bank run, like everyone shows up demanding their money.
Exactly. And because they only keep a fraction in reserve,
Uh-huh.
they can't possibly pay everyone.
So the bank collapses.
Yep. Rothbard has this image of like a charismatic speaker
Okay.
convincing everyone to go get their money out, and the whole system just crumbles.
Just based on fear, essentially.
Right, a loss of confidence.
Oh.
The other way they can go bust is through what Rothbard calls adverse clearing.
Adverse clearing, that's a new one.
This is even if there's no big panic,
Okay.
if a bank lends out way too much, more than they should,
Okay.
they might get in trouble even without a bank run.
How so?
Well, imagine someone gets a check from this overextended bank,
Okay.
and they deposit it in their bank.
Uh-huh.
That second bank, they're going to want their money from the first bank, right?
Okay.
But if the first bank has lent out too much, they won't have the reserves to cover it.
So they're in trouble.
Yeah, insolvent.
Okay, so there are limits
There are limits, yeah.
on how much one bank can, like, inflate the money supply.
Right.
But what about if they all get together?
Rothbard talks about that too.
Okay.
He says they could form a cartel.
A banking cartel.
Yeah.
Okay.
They could all agree to accept each other's IOUs
Okay.
and not demand immediate payment in real money.
Right.
And that way, they could all expand credit together.
But is that sustainable?
Rothbard's skeptical.
Why?
He says there's always an incentive for one bank to cheat.
To lend out more than they should.
Exactly, to get ahead.
Right.
And then the whole thing can unravel.
Like a house of cards.
Exactly. He uses the example of the Ricci Bank in Florence.
Okay.
They had this huge expansion, but then it all came crashing down.
Because the cartel broke down.
Yeah, it's hard to keep everyone in line.
Makes sense.
And this is what leads to these boom-bust cycles.
Oh, yeah. Okay.
Rothbard says fractional reserve banking, it creates artificial booms.
Because they're lending out more than they have?
Exactly. So there's this extra money sloshing around. People feel rich. They invest. They spend.
Like it's all built on, like, hot air.
Yeah, it's unsustainable.
So then what happens?
Well, eventually, either a bank run happens, or even just the fear of a run makes banks pull back. They stop lending. They call in loans.
Boom. Recession.
Bust, yeah. And Rothbard's point is, these aren't just random events.
They're caused by the system itself.
Exactly, by the fractional reserve system.
Okay, now, where does the central bank fit into all this?
This is where it gets really interesting. Rothbard says central banks arose for two main reasons.
Okay.
One, to finance government deficits.
So when the government spends more than it takes in, it needs to borrow money.
And central banks can provide that money.
Right.
The second reason is to cartelize the private banks.
To kind of force them into that cartel we were talking about.
Yeah, to overcome those limits on credit expansion.
So the risk of bank runs and stuff.
Exactly. Rothbard says the Bank of England, that was the first big central bank, founded in 1694.
A while ago.
To help the government finance its wars. And right from the start, it had problems. They overextended themselves, issued way too many notes.
Not enough gold to back them up.
Yep, and there was a bank run.
So what happened?
Government bailout.
Sounds familiar.
Yeah, a recurring theme.
But eventually, the Bank of England, they got a monopoly, right?
Right, on issuing banknotes.
So they were the only game in town.
Pretty much.
Okay.
And then comes the Peel Act of 1844.
Peel Act, what's that?
Rothbard calls it a double inverted pyramid.
A double inverted pyramid.
Yeah, it's like this. At the bottom, you've got the Bank of England,
Okay.
holding gold, issuing notes.
Okay.
But then on top of that, you've got the regular banks holding accounts at the Bank of England and issuing even more notes and deposits on top of that.
So it's like a pyramid built on another pyramid?
Exactly. And it's all supposed to be based on gold at the bottom.
But then Britain goes off the gold standard.
Right. Big shift.
So now those Bank of England notes, they're not backed by gold anymore.
Fiat money.
This paper.
But the pyramid scheme, it keeps going.
Built on top of those fiat notes.
Exactly.
Yeah.
And Rothbard goes on to explain how central banks ease those limits on credit expansion even more.
Okay, how so?
One way is being the lender of last resort.
Lender of last resort meaning?
Like, if a bank's in trouble, running out of cash, the central bank can step in and lend them money.
So they don't go bust.
Right.
Okay, but that seems risky, right?
It is. It encourages banks to take bigger risks.
Because they know they have a safety net.
Exactly.
So they might lend out even more than they normally would, leading to even bigger booms and busts.
Right.
Okay.
The other thing central banks do is facilitate that cartelization we talked about.
To get all the banks working together.
Right. The central bank can make sure they all expand credit at the same time.
Without worrying about losing reserves to each other.
Exactly.
Okay.
But this usually only works within one country.
Right, because other countries have their own central banks.
Exactly.
Okay.
Now, here's the big one, the most powerful tool the central bank has.
Yep.
Buying assets.
Buying assets. Like what?
Mostly government bonds.
Okay.
So imagine the central bank buys a bond from a bank. They pay for it with a check drawn on themselves.
Okay.
The bank deposits that check, and their reserves at the central bank increase.
So they have more money to lend out.
Exactly. The central bank just created those reserves out of thin air.
Wow, so they're basically creating money.
They are, and this is what allows the banks to create even more money through that fractional reserve system.
The multiplier effect.
Yep. Rothbard points out that central banks prefer to create these demand deposits.
Rather than just printing cash.
Right, because the multiplier effect is bigger that way.
Okay, and they can also do the opposite, right?
Does assets, yeah.
So that would take money out of the system.
Exactly. It has a contracting effect.
Okay.
They can also change the reserve requirements.
Like how much banks are required to hold. Okay.
And there's the discount rate.
Which is?
The interest rate the central bank charges banks for loans.
Okay.
But Rothbard says that's less important nowadays.
Okay.
Yeah.
So what's the overall takeaway here?
Rothbard says the Fed has always been inflationary.
Always?
Pretty much. Look at their balance sheet, their holdings of government debt, the declining reserve requirements.
Okay, so if that's the problem, what's the solution?
Rothbard says the Fed can't fix this.
Why not?
Because they're the ones causing it.
Oh, right. The fox guarding the hen house.
Exactly. He says we need to go back to a gold standard.
A gold standard, okay.
And abolish the Fed.
Abolish the Fed. That's a big step.
It is, but Rothbard outlines how to do it.
Okay. How?
First, you got to liquidate the Fed's assets.
Like sell them off.
Some of them, yeah. But he says the government bonds, they can just be canceled.
Canceled?
Yeah, which would actually reduce the national debt.
Huh. Interesting.
Then the Fed's gold, it needs to be revalued.
Revalued?
Yeah, so that it can cover all the outstanding Fed notes and deposits at 100 cents on the dollar.
So people could exchange their dollars for gold.
Exactly. Rothbard even calculates a potential gold price using figures from 1994.
How was it?
$555 per ounce.
Wow.
So you'd have this new fixed gold price, and the Fed would basically disappear.
Back to a gold standard.
Exactly.
Yeah.
He also talks about deposit insurance.
Yeah, FDIC.
Yeah.
What does he say about that?
He's not a fan. He calls it a fraud.
A fraud.
He says it doesn't really insure anything.
How so?
Because fractional reserve banking is inherently insolvent.
Right. They don't have enough to cover all the deposits.
Exactly. So you can't really insure that.
It's like insuring a house that's already on fire.
Yeah, kinda.
So to summarize, Rothbard sees the Fed as the root of the problem.
The root of inflation, yeah.
And the booms and busts.
And he says it was created by bankers for their own benefit.
To escape those natural market limits.
Exactly. And that's Rothbard's case against the Fed.
A lot to think about.
Yeah, a lot to unpack.
So, listeners, we've given you a lot here.
A lot to chew on.
But now, we want to leave you with a final thought.
Okay.
Given all this, what do you think are the long-term consequences of having a central bank?
With the power to just create money.
Yeah, like what does it mean for economic stability? for freedom.
Big question.
Big questions. We encourage you to keep exploring these ideas.
To dig deeper.
Maybe read Rothbard's book.
Yeah, it's a good one.
The History of Money, Central Banking.
It's fascinating, and it affects all of us.
It does.
Thanks for joining us on this deep dive.
Thanks, everyone.